You earn more than your parents did at your age. You have more access to financial information than any generation in human history. And you are statistically more likely to retire broke than they are. Let that land. You're not behind because you're lazy. You're behind because you're overcomplicating the single most important financial decision of your life. Every day, you scroll through 15 different stock picks, 3 crypto alerts, a real estate guru ad, and a podcast telling you to diversify into art. You are drowning in options while the answer has been sitting in one book, written by a man who became financially independent using one fund. One fund. J.L. Collins wrote The Simple Path to Wealth as a series of letters to his daughter, not to impress Wall Street, not to sell a course, to hand someone he loved the clearest, most ruthless financial blueprint he'd spent decades distilling. And the core thesis is almost offensively simple, which is exactly why most people will ignore it. This video breaks down the architecture of that simplicity, not the surface, the load-bearing logic underneath. Like and save this video. The concepts here are worth revisiting when you feel stuck. Here is what most people believe about building wealth. You need to be smart. You need to pick the right investments. You need to time the market. You need complexity to match the complexity of money. Collins proves the opposite. The book's central mental model is this. Every layer of sophistication you add to your financial life, the hedge fund allocation, the options strategy, the actively managed mutual fund, is not a feature. It's a fee. It's friction. It's a toll booth between you and compound growth. And that toll booth has a name. It's called the financial services industry. They don't get paid when you do nothing. They get paid when you do something. So they've built an entire culture around making you feel like doing nothing is irresponsible. Think of it this way. Imagine 2 people trying to fill a swimming pool. Person 1, let's call them the bucket carrier, runs around with 14 different buckets. Some are fancy. Some have holes. Some are sold to them by a guy in a suit who takes a scoop out of every bucket before it reaches the pool. This person is exhausted, busy, and feels productive. Person 2, the pipeline builder, spends time once connecting a single, wide, low-cost pipe directly from the water source to the pool. Then they walk away. They read a book. They go live their life. The pool fills on its own. Collins is telling you to be person 2. The pipe is a total stock market index fund. The water source is the entire American economy. And the act of walking away, of refusing to touch it, trade it, time it, or panic sell it, is not laziness. It is the discipline that separates wealth builders from wealth performers. Most financial advice is designed to make you a more sophisticated bucket carrier. Collins asks a different question entirely. What if the goal isn't a better bucket, but eliminating the need to carry one at all? The fewer moving parts, the fewer failure points. The fewer failure points, the higher the probability of a desired outcome over a long time horizon. This isn't philosophy. It's systems design applied to money. Now, let's get into the machinery. Collins doesn't deal in vague principles. He gives you a specific vehicle, a specific allocation framework, and specific math that explains why it works. The vehicle is VTSAX, the Vanguard Total Stock Market Index Fund. This single fund holds over 4,000 US stocks. When you buy VTSAX, you're not betting on a company. You're buying a slice of American capitalism itself. If the economy grows, and over every 30-year period in modern history it has, you grow. Here's the structural rule Collins builds the entire book around. It sounds elementary, but watch what happens when you apply actual numbers. Let's say you're 28. You earn $60,000 a year after tax. You invest 50% of your income, $30,000 per year, into VTSAX. The historical average annual return of the total US stock market is roughly 10% before inflation, approximately 7% after inflation. Let's use 7 to be conservative. At 7% annual return, compounding $30,000 a year. After 10 years, you have approximately $440,000. After 15 years, approximately $790,000. After 20 years, you cross $1.3 million. After 25 years, age 53, you're sitting on approximately $2 million in today's dollars. Collins pairs this accumulation strategy with a withdrawal framework. The 4% rule, derived from the Trinity study, states that if you withdraw 4% of your portfolio annually in retirement, your money has a historically demonstrated probability of lasting 30 years or more. $2 million at 4% gives you $80,000 per year, more than your original salary, without ever working again. Now here's where Collins separates himself from every other financial author. He introduces a two-fund portfolio for those approaching or in the withdrawal phase, VTSAX for stocks, VBTLX, the Vanguard Total Bond Market Index Fund, for stability. During the accumulation phase, when you're young and decades away from needing the money, Collins recommends 100% stocks. Why? Because volatility is only dangerous if you sell during a downturn. If your time horizon is 20+ years, every crash in history has been a temporary discount, not a permanent loss. As you approach your target number, you gradually shift toward bonds, perhaps 75% stocks, 25% bonds, to reduce the sequence of returns risk in your first few years of withdrawal. The entire system has 3 moving parts: your savings rate, 1 stock fund, 1 bond fund. That's it. Every additional element you add is not sophistication. It is noise with a price tag. So if it's this simple, why isn't everyone wealthy? Because your brain is not optimized for wealth. It's optimized for survival. And survival instincts are the single greatest destroyer of long-term financial outcomes. Trap number 1. The market drops 30%. Your portfolio goes from $200,000 to $140,000. Every neuron in your brain screams, sell, protect what's left. This is the same instinct that kept your ancestors alive when a predator appeared. But the stock market is not a predator. It is a system that has recovered from every single crash in its history. Selling during a crash doesn't protect you. It locks in the loss and removes you from the recovery. Collins is explicit. If you cannot sit still during a crash, you will pay the price of your own fear for the rest of your financial life. Trap number 2. You check your portfolio daily. You read financial news. You listen to someone on television explain why this time is different. Each piece of information feels valuable. It is not. It is engineered to generate attention, not returns. Every hour you spend consuming financial noise is an hour you could have spent earning, building, or simply not sabotaging a strategy that works without your intervention. Trap number 3. You hear, invest in index funds, so often it starts to sound boring, basic, beneath you. So you chase something more interesting. A stock tip, a sector rotation, an algorithm. And that chase, that need for intellectual novelty, costs you 2, 3, 5% per year in fees, mistakes, and tax inefficiency. Over 20 years, that is hundreds of thousands of dollars sacrificed at the altar of feeling clever. Collins doesn't ask you to be clever. He asks you to be relentless about being simple. Theory without action is entertainment. Here are 4 moves you execute this week. Not next month, this week. Step 1. What to do. Go to Vanguard.com or the Fidelity app. Fidelity offers FSCAX, which is functionally identical to VTSAX, with 0 expense ratio. Open a Roth IRA if you're eligible, or a standard brokerage account. Time, 20 minutes. Initial deposit, even $1. The amount is irrelevant. The account existing is everything. Why it works. The single greatest predictor of whether someone invests consistently is whether the account already exists. You are removing the activation energy barrier. Physics applies to behavior. Step 2. What to do. Set up an automatic recurring transfer from your checking account to your investment account. Choose a specific dollar amount. Start with $200 per paycheck if you can, $50 if you can't. Schedule it for the day after payday. Use your brokerage's automatic investment feature to buy FSCAX, VTSAX, or VTI with every deposit. Why it works. Automation removes decision fatigue and eliminates the monthly negotiation between your present self and your future self. A negotiation your present self wins every time, if given the chance. Step 3. What to do. Open a spreadsheet or use the free calculator at networthy.com or firecalc.com. Multiply your annual expenses by 25. That is your financial independence number based on the 4% rule. If you spend $40,000 per year, your target is $1,000. If you spend $60,000, your target is $1,500,000. Write this number down. Put it where you see it daily. Why it works. A goal without a number is a wish. A number without a timeline is a fantasy. This calculation converts an abstract aspiration into a concrete engineering target. You now know exactly what the finish line looks like, and you can reverse engineer every month between now and then. Step 4. What to do. Unfollow every stock-picking account, every crypto influencer, every financial news alert on your phone. Remove the brokerage app widget from your home screen. Set a calendar reminder to check your portfolio once per quarter. January 1st, April 1st, July 1st, October 1st. Spend 15 minutes each time. That is 60 minutes per year of portfolio management. Why it works. Collins makes this point surgically. The more frequently you observe your portfolio, the more often you see losses, because daily market movements are near random. Reduced observation frequency literally changes the emotional experience of investing from anxiety to indifference. And indifference, in this context, is the optimal emotional state. Here's the insight that most people will hear and still not internalize, because it violates everything our culture teaches about achievement. The highest return financial skill is not analysis. It is not intelligence. It is not access or hustle or finding the next big thing. The highest return financial skill is the trained ability to do nothing in environments that pressure you to do something. Collins didn't write a book about investing. He wrote a book about the architecture of enough. Enough complexity, which is almost none. Enough monitoring, which is almost never. Enough strategy, which is one fund, bought consistently, held indefinitely. The entire financial industry is built on the assumption that you need them. Collins's radical act was proving, with decades of data and his own life, that you don't. The path to wealth is simple. Staying on it is not. Not because the path is hard, but because every force in your environment is designed to pull you off it and sell you a more complicated one. The people who build real, lasting, generational wealth are not the ones with the best strategies. They are the ones who chose a good enough strategy and then refused to abandon it for 30 years. That is the real message, and it is worth more than every stock tip you will ever hear combined. Save this video. Come back to it. Most people will watch this once and return to their buckets.